But first, we begin with the markets, as we always do here on NYSE Live. Joining me now is Jim Bianco. He's the president of Bianco Research. Jim, welcome to the show.
Thanks for having me.
So, Jim, how should investors be responding to this government shutdown?
They shouldn't, at least for right now. Historically, government shutdowns have not really impacted markets unless they drag on for a long time, and then you start to miss a lot of economic data, and the state of the economy gets muddied. For instance, we'll probably, if the shutdown continues, not get the payroll report on Friday. The CPI report that would be due out next week would be at risk as well, too, of not being released. And then it could become a problem. But that said, historically, that shutdowns are somewhat bullish for the bond market because it's a draconian way of reducing the budget deficit, and the market has always been worried that the government has been releasing too much supply. But that's only if it lasts for an extended period of time. If they cut a deal tomorrow or Friday over the weekend, then it's a non-event.
All right, and the Fed cut rates for the first time this year last month, and we understand that you feel that the Fed should not continue to cut. Why is that?
Well, I think if you look at the totality of the economic data, you'll see two things. You'll see, one, the economy is actually doing pretty good. Whether you're looking at GDP or you're looking at the most recent second quarter earnings reports and the early third quarter earnings reports that have come out, it's been quite encouraging, the level of the economy. Now, yes, the payroll report has been weak and some of the labor market numbers have been weak, but that could be attributed to population growth decline because the border is shut. Almost all the population growth in the United States, comes from immigration, and we don't currently have any immigration for the moment. And on the inflation side, there is signs that the tariffs are starting to bite. Goods inflation is moving up. The overall inflation rate is moving up. So when you add it all up, this is not the environment the Fed should be cutting rates in. This is a strong economy with maybe sticky high inflation. And cutting rates like this could, at some point, bother the markets into thinking that the Fed is overstimulating and just going to create even more inflation. And you could get a bad reaction on the bond market. You saw that last year. The Fed cut rates last year because they were worried about the labor market. Their fears turned out to be misplaced. The labor market was fine. And the bond market reacted by having interest rates go up over 1 percentage point in the 10-year yield. It rejected those moves. That's the risk I think we face now.
Jim, your image is frozen, but we can still hear you, so we'll continue with the interview. So how could the government shutdown impact the Fed's decision-making on policy?
It's going to basically make it more difficult because they're not going to get any data. Whatever they thought of the economy yesterday is going to be what they think of the economy going forward. And so nothing is going to change. They are kind of on autopilot to cut rates. If we don't get any data, there's going to be no reason for them to change it. So they're probably going to cut rates again in October.
All right. And as we may not receive, as you mentioned, we may not receive the September jobs report on Friday or possibly CPI data later this month. How do you evaluate the state of the U.S. economy if we don't get those metrics?
I think it's pretty good. I think that the economy is doing good. The Atlanta Fed GDP, which is kind of like a run rate for the third quarter GDP, is near 4% right now. That is a very strong number. We were near 4% in the second quarter. Retail sales are up, earnings are up, the stock market's at an all-time high, the credit markets are at the tightest levels we've seen in a generation. You add all that up, and it's basically a signal that the economy is fine. It doesn't need stimulus. Or as the joke goes, what exactly is the Fed trying to fix by cutting rates when there's signs everywhere that the economy is doing fine?
All right, and Jim, how are you advising your clients to navigate the latest uncertainty?
I think that they have to be careful that the risk, I believe, is going to be higher interest rates, a steeper yield curve, and that will provide competition for the stock market. There's a lot of money going into bond funds right now because bond funds over the last year or so have returned about 6%. The stock market has returned a little bit more than that, but that's mainly because of the rally in the last month. But for a lot of low-risk investors, they might just look at the bond market saying 6% a year, I'll take that, thank you. And that will continue to push money into the bond market, especially if yields start moving higher. So I'd be positioned for the potential of higher yields, and that could eventually, not immediately, but eventually, be a drag on risk assets like the stock market.
And what do you feel Wall Street is getting wrong when deciphering the latest rhetoric from the Fed and the latest economic data points?
The population growth. The biggest driver of economic data in the United States is how fast is the population growing right now. And what drives that is immigration. Right now, the border's closed, deportations are up, and we might have net negative immigration. Nobody knows for sure because the data is not that frequent, but we might have more immigrants leaving the country than entering for the first time in 100 years. We might have the lowest population growth in the United States for the first time since the 1940s. Now, what does that mean? That means that if you look at a payroll report of 22,000 jobs, which we got in August, and conclude that historically that's a disastrous number, you're correct historically. But with no population growth, that might be all the economy needs in order to continue to move along at a decent pace, because we're not gaining any more people that are looking for jobs. Wall Street is afraid to talk about this population growth story, largely because it's Trump's signature achievement in closing the border, and they don't want to get on his wrong side. I mean, to be very blunt about it. And this is what I think we need to discuss. Not how many jobs are we making, what is the state of the economy, it's how many jobs do we need? And the answer is maybe not that many, and we're doing okay, even though these are historically weak numbers.
All right, thank you, Jim Bianco, president of Bianco Research.
Thank you.